Thank you for standing by, and welcome to the Sandfire Resources June 2026 quarterly report. All participants are in a listen-only mode. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Brendan Harris, Chief Executive Officer and Managing Director. Please go ahead.
Good morning, everyone, and welcome to our quarterly call. Our executive team is here with me today for the Q&A, which we'll get to very shortly. But before we start, as always, I'd like to acknowledge the traditional custodians of the land on which we stand, the Whadjuk people of the Noongar Nation, as well as the First Nations peoples of the lands on which we conduct our business. We pay our respects to their elders and leaders past, present and emerging. As always, we'll start with safety. We finished the year with a group TRIF of 1.6, compared to 1.7 at 30 June 2025, and reported 3 high potential incidents in the quarter. And of course, we just can't forget the tragic loss of our colleague, Iván Manuel Vázquez Garrido, from constructionist Mary, who was fatally injured at our Magdalena mine in Spain on the 25th February. His loss and our other high potential incidents reinforce just how important the work we have underway to strengthen our safety, broader risk management systems and leadership behaviours is. Nothing will ever be more important than the health and well-being of our people. And our people have a lot to be proud of. As you would have seen, we finished the year with very strong momentum. We delivered a 38% increase in group copper equivalent production in the quarter, taking annual production to 154.2 thousand tonnes, comfortably achieving guidance set in July 2025. At MATSA, our team delivered 26.5 thousand tonnes of copper equivalent production in the quarter, taking annual production to 94.5 thousand tonnes on the back of record quarterly mill throughput of 4.8 million tonnes per annum, higher copper grades and recoveries to further entrench MATSA's growing reputation for its consistency and predictability. And the story for Mateo is arguably even more compelling. After a somewhat soft start to the year, admittedly, our team finished strongly to deliver a 65% increase in copper equivalent production in the June quarter for annual production of 59.7 thousand tonnes to again comfortably achieve guidance. At Sandfire, it's just so important that we deliver on our commitments and do what we say we will do. Having lost space position following the floods of last year and worked hard with our contractors to reset expectations, we're back where we need to be. Having moved into the higher grade ore zones within both the T3 and A4 open pits, achieved high metal recoveries with more to come, and proven the potential of our processing facility with more than 6 million tonnes of ore processed across the year. And while, like others, we've been impacted by inflationary pressures that have built since February and the onset of war in the Middle East, the quality of our assets again shone through, as both MATSA and Mateo operated at a C1 level of less than $1 per pound across the quarter. The temporary, and I stress temporary, rise in unit costs at Mateo to $54 per tonne of ore processed does, however, require further context. I ask you consider our higher grade and high-cost A4 mine achieved commercial production, and its contribution rose in the processing blend as expected. We completed almost 35% of Mateo's annual sales on a contained metal basis in the quarter, and in copper's case, at over $13,000 per tonne, which led to significantly higher royalties and freight charges. And of course, our fleet, while well supplied, was fueled by higher cost diesel. With this in mind, it's particularly important to note that we expect only an incremental increase in unit costs at both Mateo and MATSA in FY27. In other words, a rise of around $1 to $2 per tonne from the average unit costs achieved across FY26. So what I'd really like you to take away from today is that our teams have delivered a suite of quarterly operating and financial records whilst maintaining an eye on the future, ensuring we're set up very well operationally as we move into the new fiscal year, with great confidence in the copper equivalent production guidance we've provided today of between 150 and 166,000 tonnes for FY27. More broadly, our proven projects team has made rapid progress at Kalkaroo, having quickly established key infrastructure, including an 80-person camp, and commenced our planned 130-kilometre infill and extension drilling program that underpins our $70 million pre-feasibility study, which remains on schedule to be completed in the second half of FY28. And before I conclude and we move into the all-important Q&A, I should remind you that we will have a number of other important projects on foot through FY27, including construction of our new tailings facility that will support operations at MATSA beyond 2040, the progression of the Stage 4 cutback at T3 in Botswana that sets up Mateo beyond FY29, and the DFS for A1, where mining activity is provisionally scheduled to commence in FY29. We're also looking forward to providing a broader update on our exploration activities when we report in August. And for the avoidance of doubt, I should note that we remain on track to declare a maiden reserve for A1 as promised. So, to sum up, we generated record financial outcomes in the quarter as particularly strong operating performance and buoyant commodity markets combined to deliver group sales revenue of $574 million for underlying EBITDA of $343 million at a margin of 60%. To finish the period with unaudited net cash of $353 million, an increase $277 million in the period. Our report card for the year confirms we have the right strategy. We're producing the base and precious metals the world desperately needs from two high-quality assets. Our balance sheet is increasingly strong, and we've added an attractive development option that has the potential to deliver the next wave of growth in total shareholder returns. With that, let's go to questions. Thank you.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Paul Young with Goldman Sachs. Please go ahead.
Morning, Brendan. I hope you're well, and g'day to the broader team there. Brendan, can we start with just the performance on Mateo and also discuss recoveries of MATSA, which we typically always discuss on the quarterly calls, and they're good discussions, but just on the mill throughput at Mateo, which I think was over 7 million tonnes per annum run rate. I know you didn't do any maintenance in the period, but we're now talking about a mill that's running sort of 40% above nameplate, which is extraordinary in industry terms. But just want to comment around how that was achieved, and is there anything to call out with respect to your guidance for next year, which might actually start appears to be a touch conservative.
Yeah, look, thanks, Paul. Let's start there, and we'll come back to your recoveries question at MATSA, which we always look forward to. Look, you're right. Mateo had an incredibly good quarter. It produced very well. I think it's fair to say it was set up for success. Remember that we shouldn't forget that Q3 for Mateo was probably the most disappointing quarter we've had since Mateo commissioned, and primarily because we had the issue with the OEM grate, which really meant that we had an opportunity to bring forward a whole lot of maintenance. And basically, as you should, as good miners, we took advantage of that opportunity. And therefore, again, we came into Q4 knowing that, with a pinch of luck, we were going to deliver a very, very strong end to the year, which is why we remain confident that we could achieve guidance. And look, we understand why the market was probably a little bit more skeptical. But look, Jason's probably best placed. He's got quite a lot of detail around this, but particularly I think the critical thing is to why we don't want people to get ahead of themselves as we move into the next year. Jason?
Right, thanks, Paul. And Brendan's comment there about Q4 being set up for success is on the money. If we look at it, Brendan touched on it, we had a major shutdown in Q3 that was originally planned for Q4. We did a lot of work in that quarter and opportunely during that period of time to make sure that we did not have to take down the mill on a planned basis for an extended period of time coming into this final quarter of FY26. The other point I'll make is that we saw very much the increasing proportion of A4 into the blend, right, and processing. And what we are seeing and where we are in that ore body in the upper levels, it is softer than we expect for the overall average of that ore body. So we get an overall throughput improvement there as well. The third point I'll make is that we've stated before that we've invested in debottlenecking for Mateo plant in FY26. Those works were completed and largely commissioned during Q4. So we saw the benefits of that work coming in, particularly around tails lines, right? Our ability to handle concentrate and store concentrate there at the back end of the float circuit gave us some real advantages there about maximising throughput in that period of time. So all of those things lined up to deliver what we all consider is an excellent quarter in terms of throughput for Mateo. If I look forward and if we think about it on a sustainable basis, when we factor in major planned shutdown events over an annual basis and going into FY27, we have 2 of those major shuts planned, right, for that plant. The other thing that we will see, and particularly with the further increase in the proportion of A4 ore going into the blend, we know that ore will get harder at depth, and it is harder than T3 ore. And we had originally identified that in the feasibility study for A4. We know that will have an impact going forward as well. And then from a value point of view, I touched on the debottlenecking earlier. Right, what we are seeing at the moment now, particularly with grades, head grades sitting around about 1% or slightly higher, the overall constraint in that circuit has now moved to the flotation circuit and our ability to be able to cope with the, if you like, the copper minerals. So from a value point of view, if we run it too hard on the current configuration, we'll start to see a recovery drop. And you will note from Appendix A that we are forecasting 93% recovery going into FY27.
Yep, okay. Yep.
So sorry, Youngie, if I could just maybe just sort of your comment there, I think, I understand that this sort of bent towards a question of conservatism. Hopefully from what Jason said, you'll recognise there's a lot of things that go into this. While we think that the guidance we're providing is appropriate, I think it's fair to say though that if we look back at the start of FY26, we knew we needed a lot to go right because we were still recovering from the floods. And the team, I think, has done an incredibly good job to work through that. They've obviously had to reset some expectations with our primary contractor. I think that's now looking like it's more on foot. The critical thing as we go into next year, I think, is I don't think it's conservative, but what I would say is it's a lower risk year, and that's primarily because of the face position we have sitting, effectively all bound in both of T3 and A4.
Yeah, understood. That's comprehensive, guys. Look, I'll park the recovery question up on MATSA, Brendan. Actually, keen to discuss the upcoming resource and reserve update, and I know you did a bunch of drilling in the quarter, and looks like you'll release those drill results with the R&R update, but just curious around how you think about what copper price you're going to use in your reserve calcs coming up. I know you've been pretty conservative with MATSA and Mateo. I don't have the numbers exactly in front of me, but I think, around sort of somewhere between $3.50 and $4 a pound, and Blackbeard maybe a little higher. But how do you think about this? Because it's obviously going to play into, everything you do with respect to the mine planning and even Kalkaroo and even decision on Blackbeard, where you settle on that. So can you step through your thinking around how you actually assess what copper price you will use in your estimates?
Yeah, look, thanks, Paul. And again, something that we spend a lot of time thinking about. I think we're also careful to make sure we don't believe that we have some unique insight into the copper market. So we're very careful around that. But we can see all the pressures that are building on the supply side, all the challenges with the aging fleet, rising strip ratios, and I could go on. We've historically used a price in our business of less than $4 a pound. But we acknowledge that the market's view of long-term pricing is rising. And so, you won't be surprised if, one of the considerations for us is a number that's more in the 4s than the 3s. So, now in terms of, the impact on our R&R statement, and we've given you a little bit of insight as to where that's headed. You can imagine from a Magdalena perspective and even Aguas Sanitas, that sort of move doesn't have a really meaningful impact. Even at Social, it's not overly significant. It really is only if you start pushing above 5s. Now, that's an interesting thing because we also note that a number of commentators in your world are talking of prices in the 5.50 range. That actually starts to become quite interesting. Now, when we look at Mateo, the comment around broadly replacing depletion, I said earlier on in my speech that, we're on track to declare a maiden reserve for A1. We've said historically, that could be in the order of half a year, call it as a function of throughput. I think recently we said it's looking better than that. A1 will be a big part of that initial replacement of depletion this year. But remember that we've only recently accelerated a lot of infill and extension drilling around T3 and A4. And as you start looking at prices more in the 4s than the 3s, that becomes really important as a potential further extension of life. That's why we've accelerated that drilling program in the first half of this financial year. So look, there are a lot of moving pieces. I think the other thing, Paul, the Kalkaroo, I think from an investment perspective is going to be much less sensitive if we're right. We think that the economics there are compelling at a range of price assumptions. So, obviously, again, we mentioned that the existing reserve, if we put the sorts of market type prices into the model now, we basically extract 100% of the mineralisation, and that is the challenge there, that we need to obviously extend the drilling below 200 metres along strike and hopefully significantly extend and expand the size and life of that ore body. I think, obviously, as we come back to you in August, what I'm looking forward to is providing a bit more detail around that. We're also looking forward to talking about some of the more regional and near mine type drilling that we've been undertaking. We're seeing some level of maturity in that program. I think we're getting more dexterity in our targeting, and there's probably a lot for us to talk about, but we'll leave that till August.
Okay, thanks, Brendan. That's really helpful.
Thank you. Your next question comes from Daniel Morgan with Barrenjoey. Please go ahead.
Hi, Brendan and team. Just on the Mateo, obviously a very good runner that you talked at length about that. You mentioned don't annualise this quarter, of course, because you didn't have a shut amongst others, and you mentioned you got 2 shuts coming up. Could you maybe just talk about when the shuts are scheduled at this stage? Appreciate they can, of course, move.
Yeah, look, I think that probably the easier way for us to talk to that is when we look half on half, we're expecting a relatively steady sort of profile this year. I think, Jason, we're not expecting a heavy skew from one half to another, but maybe if you can colour that sort of quarterly profile in a little bit, Jason. And noting that we've, as we said, we're well set up going into this year and we've started the year well. We're only, 20 odd days in, but it's been a good start.
That's it. So at both assets, we expect our production profile to be largely even across all 4 quarters, and even noting that we do have major shuts there at Mateo planned, and they are planned currently for Q2 and Q4.
Thank you. And just expanding on the optionality question about how different copper prices impact what you do. Are you making sure that in everything you do, you maintain the optionality of these assets if, copper prices are meaningfully higher, and what steps can you do to maintain the optionality?
Yeah, look, and I'll ask Jason to colour a bit in. So the irony with this is I actually sort of think of it the other way, that we're quite optimistic, no doubt, about the future of copper. We're optimistic for the reasons we've mentioned many times, that we think there's structural dynamics that are underpinning demand, and we think the supply side is challenged, particularly for the major drivers of the supply side, maturing, and the pressures that they face, and obviously the amount of capital that's needed to just get them to stand still. So we believe in that. The one thing we're very mindful of is as we start to think about higher, longer term sustainable prices, how do we make sure we don't fall into the trap as other miners that there is volatility in this world? Despite these structural trends, you still have deep volatility in commodity markets, and how do we make sure we set ourselves up for success? So what we do, Dan, is we've done a lot of work in our life of mine planning. You've heard us talk about the hill of value work we've done. We understand the levers we have. We also understand when we need to take the decisions. Now, when we think about, Mateo, we're starting to build into our thinking, our plans that enable us to optimise into the longer term in the event that we see even higher prices than what the market's long-term numbers are ratcheting up to today, we know that we don't have any major